This is Tom Asper with the Viper Report. In today's presentation, I'd like to discuss one of my recent contributions to Forbes.com, what to expect from bear market rallies, as well as share my market analysis as of the close on April 9th, just before the long Easter weekend. I know many of you have had little bear market experience. Some of you probably were in the market during 2007 and 2009. I would imagine fewer probably remember the dot-com bear market or those prior to the dot-com bear market. I think it's important for investors to understand what can occur in a bear market, so that way they'll be better able to have a strategy that will allow them to stay out of trouble and hopefully to profit and protect their assets, which is the key goal in most bear market rallies. Prior to the last one, there were very few inverse ETFs, so if you wanted to play the short side in a bear market, you had to short stocks or buy put options. Of course, now we have a wider array of weapons that can be helpful if you want to play the short side in a bear market. By looking at the patterns from past bear markets, I think you'll get a better handle on what can occur, as it is often a surprise to most investors. This chart goes back to 1930 and has some very similar patterns and developments that I've seen in subsequent bear markets. So we had a sharp rally in April of 1920, and that peaked out here at point A, dropped 15%, 15.6% in about 3 weeks, had a 12.2% rally, and then you can see we formed this little continuation pattern or a pause. This is what a bear market rally is. It's the opposite of a bull market correction. Market doesn't go up forever. We've seen lots of good corrections within the bull market through early 2020. Right? The severity of the recent drop suggests we may be in a bear market, and we'll talk at the end about what levels I'm watching to confirm whether this is a bear or still a bull market. After this sharp rally, the market plunged further. At this point here in June, we were down 27.5% from the high. Not a lot worse than we were just last month. From there, we had a 16% rally. This is sort of a typical formation, a flag formation, triangle, wedge, whatever you want to call it. This occurs and it changes the sentiment of the market. So the market goes up here, people are going, okay, well, this is just a rally in the downtrend. We get a decline, and they go, oh yeah, okay, that's what I thought was going to happen. Then we get another rally. At this point, people are really wondering whether we've seen a more significant low. Invariably, the market will decline further, break the support at line E, and by December, we were down 46% from that April high at point A. Then we saw a much sharper and longer lasting rebound. This is not uncommon. This was like a 1 month, 2 month, over a 3 month rally of 23.5% from the low. But when we broke the uptrend at line 5, the focus was back on the downside. This is a continuation of that chart. You can see we got quite a slide after we broke that uptrend. Ended up being down 34.8%, that bear market rally, if you will. We saw another sharp rally, often fails right at key chart and retracement resistance, 28.4% from the low. That was pretty dramatic. But those who got into the long side there were hurt again as we saw another sharp decline. This is what the S&P used to trade at that point. So we went from 16 to under $9, almost a 50% haircut. The rally many of you saw referred to a couple weeks ago, the best rally since 1931. This was the rally, right in this little shaded box here. Our recent rally matched that. You can see what happened here, as we had a rally that lasted, almost a full month, from the early October lows to the November 31 highs. It was up 33.7% from that low, and soon the bear market returned. You can draw an uptrend connecting this point and that point. You probably broke it right around in here, and after that the sellers again took over. Some of you may have read my earlier articles on Fibonacci analysis. I think there's one on Forbes.com, and I'm sure there's one in the Viper report. It plays a key role in analyzing behavior during bear markets and bear market rallies in particular. So for example, from the 1929 crash high, we got this gigantic drop, and then we began a dramatic bear market rally. And that rally, you can see, peaked out at 297.25, up over 100 points from the low. And if you calculate the retracement levels from the prior decline, you can see the 38.2%, that was at 267.85, 50%. We just exceeded that at 290.43 because we got up 297. We didn't get above 313.01. That's the key level. Now I look at these retracement levels on all the major averages. It's important to realize that the more issues or stocks, etc., in an index, the more important the retracement levels become. In other words, if you're looking at the Dow Industrials, only 30 stocks, their retracement levels are not as important as, say, the NASDAQ 100 with 100 stocks, or the S&P 500 with 500 stocks, or the NASDAQ or the New York Composite, which I find is the most broadly based, over 2,000 stocks. So I look at the retracement levels for each of those. So this rally lasted just long enough that people were starting to get relaxed, and that's sort of a key point. Bear market rallies change the investor opinion to convince them that, okay, that wasn't, the worst is over, and we're ready to go back up to the highs. Of course, we didn't make it up to those highs for over a decade later. So this rally, had one down week here. That's often what it'll take. Closed below the last 2-week lows, and then bam, it was dropped to 125 in 1931. This is another example. This is the NASDAQ Composite top. And on this in green, I've overlaid the bullish sentiment readings from the American Association of Independent Investors. Oftentimes you'll see dramatic shifts in sentiment within a bear market, and that'll help you tell you that the bear market rallies has served its purpose. For example, in this instance, the bullish consensus hit 75 in early 2000. As the market was peaking, it had dropped to 58.3%, still a fairly high level, particularly by our current standards. And then just 6 weeks later, it had dropped to 30.2%. So the number of people who were bullish in the market had almost been cut in half. That's say the market, the bullish sentiment bottomed ahead of prices. We saw that also in late 2018. The NASDAQ Composite made its low. We had a dramatic rally up. By the time we got to that high in 0.4, 66.7 of the investors were back to being bullish. That was not a good strategy, as we had a reflex rally here a month and a half later, and then the sellers really took over. Also in the article, you can use the Fibonacci projection levels to determine targets. So what you do in this, and it's displayed in more detail in the article, and I may do another special video on this, but essentially you look at the length of the bear market rally, so from this point here up to that, and then you say, well, okay, if the bear market rally just goes back to the lows, that gives you this target of 30.4266, because that was how much the difference in the rally. If you look at the 1.272 times this rebound distance, you get a target of 2703, which was hit here. 1.618, the prior rally, gives you a target of 2272. The low here was 2270 in early 2001. We got another sharp rally for a month. The downtrend resumed. This target of 1026 was not reached, but we did get close. So let's look at the bear market rally in 2008. It was quite illuminating. So the stock market made its high in October of 2007. At that point, there were 54.6% of investors were bullish. This is point one. Okay, we got a nice slide down into November. We got a rally here that retraced just a little over 50% of this whole decline. Chopped around for a while. Then we got another wave of selling into January. By that time, only 25.4% of investors were bullish. That set the stage for a pretty decent rally. This was a rally that lasted, over a month, about 6 weeks, I believe. The bullish sentiment went from 25.4 up to 34.3, and then the market started to turn lower again, making a low in March. 5 days below, the week before the low, the bullish sentiment got down to 20.4. That's historically a level that can coincide with the market bottom. The market made a new low a week later in March, and we started a dramatic rally. You can see the nature of this rally. We had several pushes to the upside, pullbacks, push to the upside, pullback. This looks very similar to what happened in our market just a week ago. The market can continue to churn higher. On this initial rally, 45.8% were bullish. That was quite a change from 20.4. We got a pullback. It dropped down, I believe, about 10 points that week. By early May, we got to 53.3%. This 0.5. Next week, it was 52.8%. As the market was making its peak in May, it was at 46.3%. Still a very high level. I think I mentioned in an earlier presentation, I was interviewing many well-known investment newsletter writers right in this period here at a conference in Las Vegas, and those that were convinced we were in a bear market in February were not so convinced, and a few thought the major uptrend had resumed, and of course that was just the start of another heavy wave of selling in the stock market. And this slide shows you that rally from the March low to the May high, kind of this reversal here. So we hit 1440. The 61.8% resistance level is around 1452. So we'd cleared the 50% resistance, but not the 61.8. We had a little decline into early June. At that point, I'd written another article, Bear Market Rallies Over, and I thought it was pretty clear that it was. The AD line had broken down at that point. So once again, using that same technique, you take this rally from 1440 minus 1257. That was a rally of 183 points, and you take 1.272 times that, you get a downside target of 1209.09. Turns out the low at this 0.1 arrow was at 1200, so quite close. Gives you a good ballpark number to look at. Well, let's look a little bit now at the current situation. So this is as of the close, as I said, on April 9th. We've had a pretty decent rally from this low. The S&P got to be 1291.86. As of the last to close on the 9th, it was up to 27.86, so about 300 points, or 600 points rather, from the low. This is an indicator that I look at, though the people who compile it say don't use it as a marking timer. So let's look at some of the current market analysis. There's a weekly chart of the S&P as of the close on April 9th. Pretty dramatic 3-week rally from the low. We got down to 21.91. Now we're closed last week at 27.89. Pretty impressive. Volume declining, but volume was very heavy on the decline. You can see, looking at the past thing, it was the heaviest volume since December of 2018 at that market bottom. Below here we have the National Association of Active Managers Exposure Index. If you search Google NAAIM, you'll find out and read about it. They don't say you shouldn't use it for a market timing indicator. I find it quite interesting. We've talked about it before in my newsletters, etc., and Forbes, but it basically, it goes from really high levels, close to 100%, down to pretty low levels. Up till this recent, you look back for the last couple of years, it only got down to about 30%. We made higher lows here in late 2018 as the market was bottoming. I pointed out as part of my series in January why the market looked vulnerable. It formed a series of lower highs. So this meant that they were reducing their long positions as we were making new highs in January and early February. That's generally not a positive sign. So we got way down here now. We've rebounded a little bit, but doesn't really suggest that that's bottomed. I'm sure we'll get a new reading this coming week on that, and it's probably jumped up. It could, go back up into the 40 to 50 area, but it's going to be a while. I run a moving average over this, a 13-period moving average, and we're not even close to that. Below that is another indicator that's really not acted as I would expect it to during this market decline. This is the bullish percentage we just discussed. It's at 36.8, so it's at a very high level. I was looking for it to drop a couple weeks ago down into the 22 to 25 range. You can see that historically when it gets down to 20, that's where we were in October, which was a good buying opportunity. Of course, late 2018, it bottomed ahead of prices the week of December 10th. Market made a couple weeks lower. It was already moving higher. So it's stubbornly high. So that two levels of interpretation is that they're too bullish and they're going to be disappointed, or that they're right and they should not have been afraid during this market decline. The jury's clearly still out on that one, but we'll keep following it. Little longer term chart of the same data, including the bearish percentage. I don't find that as usual. You can see the bearish percentage did get quite high a couple weeks ago, well over 50. It was in 2016 at the important market low. We can see the bullish was down to 17%. This was the Brexit drop, also down quite low. The bearish percent, typically when you see a high bearish level, you'll see a low bullish level. That's not been the case here. We got the high bearish level, but the bullish level is still quite high. So that's not typically what you'd see. I've looked at these numbers probably for 25 years or so, and one of the few instances I can see where that's happened. We don't go back into 2011. We downgraded debt, but at that point we had the same sort of relationship. Bullish percent was really low, bearish was quite high. Okay, how about some technical studies? So this is an indicator I featured a couple times. This is a weekly advanced decline line differential. So it determines on how overbought or how oversold the market is. This is based on the stocks only advanced decline data. So you can see this goes back to 2005, pointing out that a couple times, late 2009, 2010 correction, 2011 correction, 2016, at the end of 2018, and currently it's made even a lower low than that. That tells you how heavy the selling is, basically. So to suggest that this number is turned around and changed, you need to see it pop back above the zero line. That happened in 2010, 2011, 2016. Very sharp move into overbought levels. So far, we've not seen that happen yet. So that is consistent more with a failing rally than a new uptrend. One of the indicators I use to measure risk, I got lots of comments on this in January. It was featured quite a few times because I was looking at, this is the NASDAQ 100, and this tells you how many of the NASDAQ stocks in the NASDAQ 100 are above their 50-day moving average. So why is that important? Okay, well, looking back here, in the spring, you can see it formed lower highs. Right at this point, there were 80% roughly of the stocks were above their 50-day moving average. When you have a high number, that indicates that there are fewer stocks that are going to be a favorable risk buy, in my opinion. So then you look for divergences. At this point, you can see the market was up near its high. This was forming lower highs. We also had that point, we saw a correction coming. Our advanced decline studies turned negative. We got a sharp drop into early June, and this came down into below 20. Another nice rally into July, as the market started to peak out in July. Another pattern of lower highs. At the trade, tariff wars in August, it dropped back into these buy areas as it did in October. And then it was very strong. It stayed very high. So even in February, it showed a pattern of lower highs. And to me, I look at a bunch of different measures, number of stocks above their 50-day, 200-day, different markets. And that, along with the Stark Band analysis, indicated the market was very high risk, historically overbought, I think was the article I wrote for Forbes. Well, something like that, now we've gotten down to the others. We're at very few stocks, about hardly anywhere above their 50-day moving averages. That market's moved up. So this could be part of early bottoming process. Typically, the first move up is not a bottom, so I'd be looking for this to come back into this 10 to 15% area in the next weeks or month as a better buying opportunity. This is the same sort of analysis using the S&P, and instead of the 50-day, this is the 200-day. So you get same sort of patterns. You can see we had, peak here in early 2020, then a lower high in early March. So that meant the market was less strong as the market was making a price high than it was in earlier January. We've had very extremely low levels, bounced up to 20. So sure, that could be in the process of bottoming. You see what happened here in December of 2018, made a low. We had a rally, made a secondary low. And that's kind of what I'm looking to see down the road. This is an indicator that I feature periodically in special market updates. It's based on the NYSE All Advanced Decline line data. It gives you 3 different moving averages of the advances minus decline. Purple's a 5-day, 30-day in red, and black is a 10-day. So you look at patterns, as I discussed, that the market was bottoming out in here. We're starting to see some bullish divergences here. The short term, the purple, didn't make made a higher low here, came back into this level a week and a half ago, setting the stage for another rally. And as we head into the long weekend, we're at quite extreme levels around 1532. So that's probably unsustainable. So what's next? Probably come down into this 300 to 400 level. If the selling is heavy, it'll drop back into more oversold territory. Lower risk buying occurs when it gets down in here below minus 700, ideally minus 1400, and starts to bottom out and turn higher. Then you can suggest that the market is ready to rally. Right up in here, it suggested the market was vulnerable heading into the long weekend. We look at the new high, new low analysis. S&P cash, 20-day moving average. These are the Keltner channels, since Stark bands are not available on stock charts. This is the NYSE new highs and the new lows. So you can see at the lows we had a little divergence. The new lows peaked right in here as the market was making a new low in price. Fewer stocks are making new lows, so that's a bullish sign. What you then like to see, and subscribers should have received a trading lesson on this, is you just like to see some positive action in the number of new highs. So far we haven't seen that. It was 12. So this peak up here is around 50. So in order to suggest that a rally is sustainable, you want to see an expansion in the stocks making new highs. You can find this daily, on a free Wall Street Journal site. And new lows, they've definitely cooled down here. Oftentimes you'll get another peak up in here that will not surpass these prior twin peaks, but maybe get up to be 1,000 if it's a really heavy decline. But that'll be another bullish divergence and suggest maybe market has bottomed. On a short-term basis, here's another look at the AAI bullish and bearish, as long as with the retracement level. So the 50% retracement level for the Dow is at 23,8877. For 61.8%, 25,222. Remember, it's the least reliable information is on the Dow because there's only 30 stocks. A little more important here for the S&P. Okay, 2792. That was the 50% level. We surpassed that on April 9th. So the key 61.8% level is at 29.34. So if we get a close above that, and we get a close in the 61.8% of the NASDAQ 100 and the NYSE Composite, it will shift the balance of evidence to the more bullish case. Currently, this looks like a rebound within the downtrend. It has a quality target of 28.92, so that's about 100 points above where we closed on Thursday the 9th. Certainly attainable with the kind of moves we've been seeing here. 100 points in the S&P used to be unheard of, and now it's sort of almost regular. So looking at the QQQ, it's been the strongest. It's been our favorite from the long side. You can see we already have made it above the 2,000 to 50% level, 2,205. 61.8% is 210.41. So that'll be the next level to watch on the closing basis. What I haven't liked about the rally is the volume. Typically what you like to see, you look at the prior market action. If you see a strong volume in an uptrend, then you look for the lower volume on a pullback. So, and when you have a decline like this and you see very heavy volume, you want to see increasing and improving volume on the rally. So far, up through Easter, we had not seen this. This one day here was Tuesday before Good Friday, was a reversal day. We're up sharply, closed down on the day, and the volume was the best on that day. So the on-balance volume here, is looking pretty weak. It's barely above its moving average, but still well below the highs. And if you've drawn, at this point, you drew a downtrend connecting these peaks, it hadn't moved above it. Okay, some of the sectors, so you look at all 11 sectors, you see which ones are the strongest. Well, XLV is one of the strongest, so you can run the same retracement analysis on the individual sectors. So it had quite a decline. So last week it closed above the 61.8% retracement resistance at 92.62, and also back above the 20-week EMA, which is this line in red. So that's pretty strong. This is the relative performance analysis. Those of you who go to the Viper report on YouTube, you'll see a bunch of videos on using relative performance. It tells you how a stock or an ETF is performing vis-a-vis the S&P. So when it's rising like this, this means it's acting stronger. In an up market, you want to be in those stocks or ETFs that are acting stronger than the S&P 500. In a downtrend, you want to be short those stocks that are acting weaker than the S&P 500. So XLV healthcare is definitely stronger, and at the close of the week, the on-balance volume had flipped back to positive. It moved above its moving average. Not such a positive picture for the financials. This is the XLF. It had a good week last week, but you can see it's just barely made it above the 38%. 50% retracements, 24.28, 61.8, 25.89. Relative performance here, still well below its moving average and declining, so it's acting weaker than the S&P. And the on-balance volume here is also below its moving average, so it's also negative. So of course we have bank earnings coming out next week, and this suggests that bank earnings may disappoint investors. So because of a technical glitch, I had to reproduce the original presentation. I apologize to those subscribers who were there live. I hope you enjoyed it. This presentation was for subscribers only, and I reproduced it so I could share it with the general public. If you'd like to become a subscriber and want specific buy and sell advice on ETFs, if you go to viperreport.com, you'll see a list of my articles as well as a link here to the Viper ETF report. It'll explain what the service is. You can sign up through PayPal. It's $34.95 a month. You'll get 2 reports a week at least in volatile times. Past several weeks, as the market's been crazy, we've been doing updates almost daily. And we'll give you specific buy and sell advice. New subscribers also get 6 trading lessons, which is about a $45 value. If you're interested in stocks, you can click on the Viper Hot Stocks report. It'll tell you about that. It's a little shorter term. I don't give any really buy and hold. Some of our positions in ETFs we'd hold since early 2019, stopped them out with nice profits and on the market slide. A little shorter term in the stock service is still tied around my AD line analysis. Also, same price, $34.95. Specific buy and sell advice for stocks if that's something you're interested in. So I hope you found this presentation beneficial. And if you go to the Viper Report, you can also click on this link and it'll take you to a sign-up page. It'll send you an ebook and it'll put you on my mailing list, and I send out regular messages and market commentary. So good luck in the markets. After the past couple of months, I'm thinking the volatility is not going to go away for a while, so things should be pretty crazy, and I hope you're well prepared for it. Thank you for tuning in.